Mike, I got to start with the tech sell-off. Do you buy this dip?
So your current login.
Yes, you do, David. And the reason for that is the sell-off we're seeing in the US is not just a valuation-based sell-off, that is not an operational sell-off, but it's a relative valuation argument. What they're arguing in the States is that these changes to the tax law will benefit companies that are not in the tech space more than it will the tech companies. Now, if you're not making a profit, you're not paying much tax anyway, so those companies like Uber that have never reported a profit won't be much affected by the changes. And the reality is in the tech space, there are a lot of loopholes that allow them to reduce the overall tax benefit, and the concern is we'll see a closing of those loopholes. So this is really about non-operational issues. Tax, of course, is important to valuation, so it does have an impact on share prices, but it's really about the other industries getting a leg up on the tech industry. So the pressure we're seeing there is a relative valuation argument. People are switching, they're rotating out of tech stocks where they've got some very significant gains and into other parts of the market. That shouldn't affect the operations of many of these companies, and that means the sell-off that we're seeing in our region is a knee-jerk reaction and an opportunity for investors.
So I stay long on that one. Any other adjustments, though, that you think I should be making into next year? I mean, a lot of people have called out just getting out of the index ETFs, getting straight maybe back into active management, get into some of these least loved, say, sectors, financials, for example. What would you recommend?
I think active management is the way to go, and it's certainly been the way to go for the last 18 months. The reality of that big shift into passive investment appears to be a capitulation from investors. They found it too difficult to pick the market, they're too difficult to time their entries, and too much. It's taking up too much of their time to be watching the market, and so they've given up and gone into the index. But the reality is the rewards, the big returns over the last 18 months have come to the active investors, those prepared to move when a stock moves in their favour and give themselves room to move when stocks are hit hard. And it's that style of investment that has won quite clearly over the last 18 months. I believe it will be even more the story of 2018. And active investors, once again, very much poised in a low growth environment where a lot of indices are likely to consolidate at higher levels. Active investors who are switching between stocks are once again likely to be the winners.